for joining this webinar series. My name is Tyson Mavar. I'm an advisor here with the Retirement Group in Texas. And on this evening's webinar, what we wanted to focus most on was the stock market and the emotional response that we've been seeing from our clients, and that we've seen time and time again when we have a little bit of a shakeup in financial markets. Interest rates are at record lows. A stock market has declined close to 30% in about a month's time. So it's been a very emotional last few weeks. In fact, many of our clients, many of you may be at home, maybe working from home right now. We had to cancel our seminars this week as a result of social distancing that we're trying to help our country deal with this coronavirus issue. So in any event, what we're trying to do tonight is focus on what happens anytime the value of something as sacred as our retirement nest egg and our life savings falls in value and the emotions that go with that. So we're going to go through one of my favorite seminars that we cover throughout the year and some of the issues dealing with volatility in the stock markets, as well as some opportunities that are now at the forefront with the result of the changes that we've gone through in the last month. So those of you that are not as familiar with our group, the Retirement Group is an independent financial planning organization that specializes in working with corporate employees in an effort to plan for and transition into retirement. We manage retirement assets. We do that at Charles Schwab. And we focus on a handful of companies throughout the U.S., and each one of our advisors has to go through extensive training in an effort to understand the benefits plans of the corporations whose employees we would like to help through this stressful transition in many cases. Some of you may already be retired, and congratulations if that's the case. Those of you who are not retired yet, you still probably have a lot of work in front of you and a lot of decisions that you'll have to make that are irrevocable in many cases and lifetime decisions. So we'd like to be a resource to you. We do these seminars and webinars and one-on-one meetings with individuals to hopefully make it a less stressful transition. And whether or not you decide to become a client or do any business with us, we hope that you found value in the exercises that we go through, because at the end of the day, we are still trying to grow our business, and we hope that you have good things to say about us among your coworkers as you transition out of the company that you may have worked for several decades and made a lot of relationships with some people. Variety of different plans that we go through: the savings plan, the 401ks that many of you may have had the opportunity to save in, and the investment options you have, the pension plan and the options that you have to take either a lump sum or a variety of different options to take a lifetime annuity. And you'll have some options with regards to your health care as well, for those of you, especially if you've had the opportunity to qualify for the retiree medical plan. But there's going to be other decisions that have to do with Medicare and potentially Medicaid, long-term care. And those are big concerns for a lot of the people that we work with. So we hope to be able to add some value and shed some light on some very stressful decisions that many people make. And at the end of the day, the way that we can help you most, whether or not you're a client yet, is through the cash flow analysis that we do complimentary for everybody that attends our seminars and is willing to schedule some time to speak with one of our advisors. It doesn't cost anything, but it will take a series of questions that we ask about your financial situation, and we're happy to help you gather the information. It's basically just the resources you have, your pension lump sum or annuity, the balance on your 401k, any other accounts that you may have saved for in retirement, and then ultimately what you think you might need to spend in retirement to feel comfortable. And that's something that we may be able to help you with in understanding the expenses that we see change for the retirees that we've worked with through this transition. Now, we go through this checklist whenever we're building a retirement plan for an individual, and at the very top is something that is more important now than ever: comfort and emotions. Oftentimes, we're not going to make a decision unless we are comfortable with that decision, and if we're not sure, then we just won't make any decision. Many people that we're working with, for instance, at Chevron, one of the oil and gas companies that's going through some reorganization, they're having a decision whether to leave their company or to at least raise their hand to leave a company and take a severance package. Now, there's a variety of reasons to consider that, and plenty of people, it's probably not a good decision to leave if you can't afford financially to retire. Many people will not take that offer or express interest in the offer because they're not psychologically ready to leave their company. So part of our job is to help you get psychologically ready for when the right time comes. This could be an absolute great opportunity to not only retire, but take a pension plan and invest at very low bargain opportunities in the stock market. And especially with interest rates as low as they are right now, record lows, the Federal Reserve just last weekend, in an unprecedented decision, decided to change their target interest rate to 0%. 0% is the federal funds rate that banks lend to one another. And now that's not the rate that companies pay out pension lump sums on, but all the rates in the money market are correlated with one another. And in fact, the Federal Reserve has actually considered, or at least former Federal Reserve chairmen have considered allowing the Fed to actually purchase corporate bonds, which would drive down corporate bond rates, which would be incredibly advantageous for lump sum recipients, because it would reduce the rate that they use to calculate your pension and increase your pension potentially very substantially. But the reality is there's a very innate emotional impact of leaving a company, especially if you work there for several decades potentially. So we don't want people to make decisions emotionally, because what studies have shown is that whenever we rely on our emotions for big decisions like our retirement, oftentimes we make decisions that we end up regretting, or decisions that are not in our long-term financial best interest. So that's what we'd like to help folks and take you through that decision-making process, and also tell you some stories, and whether they're success or failures of people that we've worked through this same transition over the last couple decades that we've been in business. Understanding the risk and how volatility plays into that risk. Volatility is what we've seen in the last several weeks. It's the uncertainty with the value of our investments in our retirement portfolio. And while volatility is probably okay for money that we don't need for a while, think of a retirement time horizon maybe as a 30-year game plan that we're putting together. Some of that money we won't need for 15 plus years, and that money is probably okay to be invested in the stock market. Of course, everybody's different, and we need to get to know your personal circumstances before we can recommend an allocation or any specific investment. But what's common between all of us is that money that we need soon probably should not be invested in the stock market because of its unpredictable nature, especially what we've seen in this last couple months. We're now in a bear market. We've enjoyed a very long bull market until toward the end of February of 2020. Now we're in an instance where we are more than 20% below where the previous high. So we're now considered what they call a bear market. So there's risk in a retirement portfolio, especially if you had more than you should have in stocks. There's going to be a level of stress that maybe you don't have the solvency or the ability to pay your bills without having to sell those stocks while they're down. So part of our job is to help to build an allocation to where we have other buckets other than stocks that aren't impacted in this environment. We have lots of different resources to draw from, so we can have the confidence that we don't need to sell our stocks while they're down, and we're going to have plenty of time to allow those stocks to recover. It also goes into choosing quality stocks. And we do an entire presentation on our philosophy of value investing, which is buying good assets, but only when they're at a good price and never overpaying for investments. So all of those go into risk. Another risk, of course, is inflation risk. And I've had many clients call me this week wanting to sell all of their stocks because with the most common phrase I would say this week was, how do I stop the bleeding, quote unquote? When in reality, the effort to stop the bleeding, if you will, has us selling our stocks at a loss, and an assumption that we'll be able to reinvest or get back into the market somewhere near the bottom or lower than we got out of the market. When in reality, what our emotions we found drive us to do as investors is not feel comfortable owning stocks until after they've gone up. And typically where people have made the biggest mistakes in the previous recessions that we've worked with people through is selling their stocks after they've gone down and waiting to get back into the market until they feel comfortable, which is inevitably when those stocks have recovered. Primarily, we're interested in increasing our clients' retirement income. And so we do that through maximizing benefits, whether it's taking a right option on the pension, electing the pension at the correct time, making sure that we're minimizing our taxes and eliminating penalties, as there's many when it comes to all of these decisions through our retirement process. And then ultimately developing a philosophy about retirement through what's important to us. And you may not know exactly what your vision for retirement is. That's okay. That's something that takes time for people to understand what you're going to be doing with all this new time after you leave. And I've worked with people that continued to work well past when they should have, both from a physical perspective and a financial perspective. As it turns out, you can actually work too long and hurt yourself from a financial perspective, just because they didn't know exactly what they were going to do, and they were actually fearful of that idle time that comes in retirement. But that's not what retirement should be about. Retirement should be about enjoying hobbies that maybe you didn't have time to explore when you were working, or doing things that are a lot more fulfilling than you may have had the fulfillment from your job. It's a blessing to have fulfillment from things that you're doing in your job, but part of the planning process goes into figuring out what's important to us, who's important to us to be able to spend more time with or help from a financial perspective in retirement. And that's a big part of the planning process that we go through with our clients that are approaching the point where they are now self-reliant. They don't have a paycheck coming in. So figuring out where the paycheck's coming from, but also what we're going to do with this extra time becomes a big part of the transition process. Now, inevitably, when we're retired, most of our clients that work for Fortune 500 companies can't afford to have all their money in guaranteed asset classes, such as cash or CDs. So when we run that cash flow analysis, we look to identify what's a reasonable rate of return that, number one, isn't too risky for an individual, but also is enough to make their money last as long as they feel it needs to, whether it's age 80 or age 90, or maybe it's well past age 90. We want to have a very conservative plan that allows our funds to be sustainable and not putting us in a situation where we are concerned we are going to run out of money or feel like we may have to go back to work when we decided we would never want to work another day in our life if we didn't have to. But inevitably, most of our clients have to invest in stocks to get that return. And as a result, there's going to be fluctuations. This has been an incredibly stressful time for many of our clients in these last several weeks, seeing their assets decline 10, 20, some even as much as 30%. Those, of course, are typically younger folks that are having a higher percentage of their net worth invested in stocks. But even when you're still working, it's stressful to see what you're counting on as your retirement nest egg dwindle in such a quick fashion. Now, the reality is the stock market will come back, and at least that's our opinion. Now, when will that happen, and to what degree will it increase or recover? That's very difficult to guess at. And so we just assume that we do not know, and we look to recent recessions, even though past results are not indicative of future performance. What we try to do is make sure that we are not suffering the emotional roller coaster or making decisions based on our emotions, because what we found is over time, studying the psychology of investors is we feel good about buying investments after they've gone up in value and when they're most expensive, and we don't feel good about owning investments after they've gone down in value. So our psychology actually produces this buy high, sell low type of mind frame, which is actually the opposite of what's in our long-term best interest and what we're dealing with on a day-by-day basis. This has probably been the busiest time maybe in my 10-year career with the retirement group, but this is where we are making our compensation, is being available for our clients to maybe just be a sounding board and instill some confidence, or have a pep talk to realize that this too shall pass. And remember, this is a marathon and not a sprint, meaning that as long as we have our short-term bills covered, we're not as worried about our stocks. And that's not to say that we don't revisit the portfolio and review where we are. And oftentimes this is a good opportunity to rebalance. But if we had a lot of cash going into this situation, this is actually a great opportunity to pick up some good bargains of companies that may be unreasonably low priced. In other words, they're not justified for why they're trading at such low cost per share. That's what we'd like to take advantage of as value investors, pick up some bargains. That way the rebound ends up being even better than the severity of the downturn, which has been pretty severe compared to even previous recessions that were pretty severe. Now, here's the three-legged stool, which is resources we count on in retirement. 401k plan, we are, for the most part, responsible for that through our career. The pension plan, for the most part, the companies are responsible for, if we are blessed enough to have one. And then Social Security is something that the government is responsible for administering. However, it's us that paid into this throughout our careers, and now it's time to start collecting. So there's a lot of options with all three of these. And right now, we're going to focus mostly what we have control over, or the most control over, which is our 401k investments, as well as how to take the pension. We mentioned earlier that interest rates are very low, which means lump sum payouts are very, very high historically. Again, that's not necessarily a reason to take the lump sum, and we might actually recommend the annuity option to a client if the circumstances fit the income stream that is connected with the annuity. But lump sums are very attractive right now with interest rates as low as they are. And when lump sums are high and the stock market is relatively low, great time to retire for those of us that can afford to retire, because it just might so happen that we are able to reinvest that lump sum at better bargains in the market, or just increase our cash position when we retire so that we increase the time frame that we have to where we don't have to sell our stocks and we can live maybe several years off of our pension plan before having to dip into our stocks or choosing when to sell our stocks at a better price. With our clients, we go through these behavioral characteristics because it turns out that our psychology is not wired to make good decisions with our money. At least that's what a Nobel Prize winning study has shown, is that our emotions drive us to make decisions that are not in our long-term best interest. Loss aversion is one that we've been dealing with most in these last few weeks because, let's face it, folks, as humans, we don't like to lose money. And what this results in is oftentimes, in an effort to curb the losses on our investments, we make mistakes by selling our assets at a loss because we predict that the losses will continue. And oftentimes we fear the worst, that maybe our money will go to zero or we will completely run out of money because we didn't do something about it. Narrow framing is another characteristic that we go through with our clients, and not understanding the decision-making process. Anchoring, which has to do with regret or fear of the past. Maybe it has to do with purchasing a security and not wanting to sell that security for less than we purchased it for. Even if it was rather arbitrary what price we purchased it at, sometimes it would actually make sense to sell something for less than we bought it for if the true value of that security is even less than we could sell it for today. Mental accounting is another big one, like we talked about earlier. Pension plan and the 401k plan are two buckets of resources for our clients. Oftentimes, clients will allocate their portfolio without even considering the pension plan as an asset. But in reality, that pension plan is like a bond holding, and that bond matures when you retire. So that could substantially change the way that we allocate our portfolio if we realize the resources that we have, going back to that three-legged stool that we looked at. Whether you take the lump sum or the annuity on your pension will drastically change the way that you might want to invest your 401k based on the liquidity of that bucket of assets. So we looked at all resources from a perspective of how we will use them in retirement, and oftentimes the folks that we work with, our clients and prospective clients, don't always look at things from a big picture perspective on what their retirement resources will be. Herding and media response are a very big one right now. With having strength in numbers, I'll have people that were not concerned at all about what was happening in the market, but after having talked to, whether it's a coworker, a family member, even the media helps to herd decision making, especially in our country and especially today with the advent of social media, where a lot of people get their information. The media response has been amplifying a lot of the fears that people that we're working with are going through. And that's not always a good thing. And it's not to say that the media is unscrupulous in their information, but let's face it, the media is paid to get ratings. And what sells oftentimes are emotions, whether it's greed or fear, but typically it's fear that the media feeds off of. And whether or not the media actually has something to talk about, you better believe they're going to find something to talk about, because that's how they actually pay their bills. So we go through these behavioral characteristics to help our clients to first identify the emotions that we go through as individuals. And then once we meet with an instance of this last month in the markets, now we are at least aware of the emotions that we can help to navigate through the emotional time frame, so we don't make expensive mistakes such as selling assets for less than they're worth, and then maybe waiting too long to get back in the market, because market timing is a very, very difficult, if not impossible, task for an investor. Here's an example of the herding effect. These are mutual funds that, when we see mutual fund performance over time, turns out that the mutual fund, or just a money manager in general, maybe it's the CEO of a company, or maybe it is a financial advisor, for instance, and their track record. Turns out that the best track record of mutual fund last year oftentimes isn't the best performing mutual fund the following year. And through the herding effect, what we do is we look for winners, because we extrapolate that a winner yesterday will be a winner tomorrow. Turns out it's often not the case. And in fact, sometimes it's actually the opposite, because when you buy, let's say, an individual stock, for instance, that did really well last year, now we have to pay a higher price for it. Same thing with mutual funds. If a mutual fund manager did very well, oftentimes they will raise their expenses. So it goes back to a quote from a money manager. His name was Peter Lynch. And Peter Lynch managed Fidelity Magellan for, I think it was about 13 years, in the late 80s to the the late 70s to the early 90s. Peter Lynch had a phenomenal track record during his tenure at Fidelity Magellan. It was something over 20% per year on average for his tenure. But what he found was that when looking at the success of his investors in the fund, was that the mutual fund investors in Fidelity Magellan actually lost money on average during his tenure. And so what his opinion was the reason was because whenever Fidelity Magellan had successive quarters of good performance, people were pouring money into Fidelity Magellan. And whenever Fidelity Magellan had successive quarters of poor performance, people were pulling their money out, which just goes back to what we talked about with our emotions driving this buy high, sell low type of strategy, which ultimately is the opposite of what we want to do. And that's inevitably one of the reasons people run out of money in retirement, is by trading the account and relying on their emotions to do so. This chart goes through net new cash inflows to mutual funds, similar to the story we told with Peter Lynch and Fidelity Magellan and his experience. What you can see is in blue, those are inflows to mutual funds as a percentage of total net assets. The green line is the stock market performance. So you can see when the market's performing well, people are pouring money into mutual funds. And when the stock market is performing poorly, on average, people are pulling money out of the market. So and this is just a 16-year period, but this goes all the way back as far as we can research, as far as statistics have been taken on how people react with their money in the stock market. And time again, what it shows is we make poor decisions with our investments because our emotions drive us to do so. Here's an example of media response. We have some articles from the end of 2019, both negative and positive. So the first one is, a crash will come, and that's okay. Wall Street Journal, October of 19. And then in November, less than a month later, why corporate America is bullish on the economy, and that's Investopedia. Then in November, we have a negative article, China trade war rears its ugly head again, knocking stocks lower. Not too much earlier than that, the unexpected trade war outcome will send stocks soaring. That was MarketWatch. Another one, U.S. losses from Trump's China trade war will never be recovered, shipping data tells us. That was November of 2019. Same month, what is the U.S. getting out of Trump's trade war with China? Not much. That's November of 2019 again. So our best advice is stick with a long-term strategy. Whether you're doing things on your own or you're working with an advisor, such as one from the retirement group, we want to put together a plan that meets our objectives, meets our cash flow needs. It's not too aggressive to where we're losing sleep at night or panicking, and to where it is consistent with our not only our risk tolerance, but also our capacity for risk and the ability for us to take risk based on our cash flow needs. Try to turn off the television when it comes to investment news. That includes the internet and surfing, especially when you're at home, maybe working from home. Could be easy to get caught up in the hysteria related to the coronavirus or related to the surplus of oil that has driven oil prices down, and it could be an additional stress on our economy going forward. And try not to feel like you have to react to every piece of information you hear. Some information we get is relevant, some may not be so relevant, some may actually be in the opposite of our interests. But our best advice is to have many different resources and do your own due diligence. But we hope that we can be an advisor, or at least a resource to you as you make some of these difficult decisions and navigate through this very difficult stock market and economy right now. Loss aversion we talked about is probably the biggest one affecting our clients. We go through this exercise in our seminars that we do throughout the nation, where let's say we flip a coin. Heads, you lose $10,000. Tails, you win. The question is, how much do you have to win to be willing to make that bet to potentially lose $10,000? So think about that for a minute. How much would you have to bet, or excuse me, how much would you have to win in order to be willing to potentially lose $10,000? Everybody's different in their answer to this, and this is helpful in understanding a client's risk tolerance and what's an appropriate allocation for their retirement income or for their retirement portfolios. I had in the seminar that we did toward the end of last year, somebody said they would have to potentially win $1 million on tails to be willing to gamble $10,000. I would say most people are not that risk averse. Some people, if you are what we call risk seeking, may be willing to accept just $10,000. So 50% shot, you win $10,000 on tails, you lose $10,000 on heads. If you're somebody who goes to the casino because of house advantage, you're actually saying that you are willing to accept less than a $10,000 win for a $10,000 potential loss. And that's just part of what we accept when we go to the casino. Hopefully you get some entertainment value when visiting the casino. Turns out that the average individual must gain 2 to 2.5 times of what they were willing to lose to be comfortable to make that bet. So that's an example of loss aversion. So in other words, we'd have to win $20,000 to $25,000 in order to risk $10,000. But simply put, we just don't like to lose money, and sometimes that actually works against us when it comes to our retirement portfolios, especially when we're close to or already in retirement because we don't have a paycheck coming in. Now, here's one example of, again, our emotions when events happen in the stock market or in the economy, how oftentimes it will drive us to an instance of making poor long-term decisions. Here we go through different recessions or through these dark gray bars. The most recent one was 2008, the housing bubble and the subsequent global financial crisis that ensued. Previous to that, we had the dot-com boom and bust. And then we had in the early 90s, we had issues with oil prices, and we had some very serious issues in the late 80s with the 1987 Black Monday, which actually was the worst day in the stock market previous to what was this last Thursday and last Monday were the next two worst days in the stock market since 1987. So it's been a rough couple of weeks to say the least. But what we're showing here is that every time the stock market declines, so too does what's in the blue line, consumer confidence, or our comfort level with investing in stocks. So it turns out we are less inclined to buy stocks when they're cheap and more inclined to buy stocks when they're expensive. Again, opposite of what we would do at the grocery store, opposite of what we do when we're buying Christmas presents. But when it comes to our money, especially our retirement portfolios, it's very difficult to stick with the long-term plan and not try to time the market or stop the bleeding, as many people have told me this last couple of weeks. Now, it comes back to interest rates. Inflation, of course, is a big risk on a retirement portfolio. And for those of you that have gone to cash and are attempting to time this market, one of the risks is that your money will not be earning interest while you wait to get back in the market. And for a retirement portfolio, for many of our clients that needs to grow at a certain rate of return, maybe it's 4%, maybe it's 6%. At the very least, we must on average beat inflation for most individuals just to have our money lasting as long as it needs to, or not have our principal eroded by the effects of inflation and decreasing purchasing power. Well, it turns out that interest rates and inflation are correlated. When interest rates are low, typically inflation's low. And one of the problems with keeping interest rates low is that it could spur future inflation, which could be bad for retirement portfolios, whereas our investments need to grow or have a bigger hurdle just to keep up with cost of living. Well, it turns out when interest rates go up, lump sum pensions go down, but so do fixed income investments like bonds, which are have typically been an important part of a well-diversified retirement portfolio. So this is a risk going forward for folks that are retiring in a low interest rate environment. Not only will you may not be able to get a rate of return that's sufficient for your income needs through your fixed income investments at least, but as interest rates go up, you could see your fixed income portion of your portfolio, your bonds actually decreasing in value. So there's risk related to that, but there's opportunities right now, whether it's taking a lump sum on your pension. There could be opportunities for borrowing, whether it's refinancing your mortgage or maybe taking out a note on an asset that you may not already have debt on. We have to look at your specific circumstances, not only the interest rate that you could be able to achieve, but this is something that I have to talk many of my clients out of when they retire, is paying off very inexpensive debt and taking money out of a retirement account where they are actually paying taxes in order to do that. Sometimes it doesn't make sense. Sometimes it does. Everybody's different. We have to look at your circumstances. But the fact remains that interest rates are at historical lows, and there could be great opportunities as a result of this. So what's the next step? Well, first of all, we want to give you an opportunity to take advantage of the cash flow analysis. Again, it doesn't cost anything. We will need some information from you to put it together. And we'll take normally a 30-minute to an hour, whether it's a web meeting. Probably not doing too many in-person meetings right now. Most people are just trying to stay away from everybody in an effort to not spread germs and stay healthy as we try to figure out what the next couple weeks holds with regards to the coronavirus. But web meetings, we're very happy to set one up where we walk you through the process of every single year of retirement, where your money's come, where the taxes are going, how much you're spending or can afford to spend if you're not exactly sure what that number is, and then ultimately what's left over at the end of the day. So you have a long-term game plan and can have some confidence that even when the stock market is very low as it is right now, as long as we make good decisions through this stressful time, that you're going to be just fine. Understanding all the risks that are associated with the retirement plan: inflation risk, investment risk, risk of retiring too late. It turns out you can actually lose money by retiring too late. And understanding the returns that are required to get your assets to last as long as they need to, which is the rest of your life and maybe beyond for those of you that want to build a legacy for your family. Avoiding the big mistakes. We talked about the mistakes of selling our assets when they're down because we let our emotions take hold. Mistakes of overpaying in taxes. That's one thing we run the cash flow analysis to identify. Our tax strategies to minimize your taxes for your lifetime, not just today. And then those 5 concepts we talked about: understanding the emotions, understanding how much paycheck you can generate through your assets, and making sure that that's a sustainable paycheck, one that lasts as long as it needs to. Understanding what's important to you about retirement so that we have a vision for retirement. We understand, number one, what we're going to be spending money on. It could be ourselves, it could be people that we care about, and when we intend on spending that money, so we can build a plan that allows you to do the things you want to do and not have to worry about where the stock market is on a day-to-day basis. Choosing experienced investment managers. Retirement Group has been managing retirement assets since the early 90s, but it also comes down to the managers that we pick to manage the assets that our clients are investing in, especially stocks. One story I've been talking a lot about recently, because it's a pretty core holding for a lot of our clients' assets, is Berkshire Hathaway stock. We like it because it's a very good track record of the management team. They have the ability to go to cash, and they've done a good job of doing so in previous recessions. Cash is a key component of a retirement portfolio because not only does it create the liquidity that we need to pay our bills, but like right now when valuations were very high, Berkshire Hathaway was holding on to $125 billion in cash. So that's incredibly helpful when now not only has their stock price not declined as much, but now they can go back and redeploy that capital into market when there's a lot better bargains today than there were 2 months ago. And then ultimately revisit the portfolio. We talk about not making rash decisions right now while the market has dropped significantly in a short period of time. That doesn't mean you shouldn't revisit your portfolio and your allocation. I've done a lot of rebalancing with my clients and made an assessment of, well, let's look at our cash flow or what we need for the next couple of years. Let's look at our portfolio and where are there some potential opportunities where we can take advantage of the bargains that exist today. Everybody's different. That's why we want to have a one-on-one conversation, get to know you a little bit better, understand your objectives for retirement, and try to put together a plan that will be sustainable through this tough time that we're going through, and that can ultimately have your money lasting as long as it needs to and potentially beyond to allow you to do the things that you want to do in retirement and do it on a low-risk basis to where you're not spending so much time worrying about it for the rest of your life. Best way to reach us, you can call us at 800-900-5867. You can visit our website at theretirementgroup.com. I encourage everybody to visit our blog where we're coming out with up-to-date information relating to the markets today, as well as our ebook library where we have a lot of content and resources, not just on investments, but Social Security, estate planning. We look at tax rules and changes that have happened, different strategies related to those. And we have a great library of retirement guides that are specific to each one of our companies that we specialize with. So we hope you take advantage of that. We hope that you get enough value that you will help us grow our company by referring us to some of your coworkers. Whether or not you do any business with us in the future, we hope to get an opportunity to get to know you and add some value to your retirement plan so that you can return the favor to us through referring us to some of your colleagues and coworkers at your company. With that, we're going to wrap it up. Thanks, everybody, for joining us on this webinar series. My name is Tyson Mavar. I hope to have an opportunity to help you all very soon, and we hope you all have a safe and good rest of your weekend.